Plug Power Inc. is currently trading at exactly 1.84 USD, plummeting 0.30 USD or 13.79% in today's brutal intraday session. If you are looking at your portfolio right now, you are likely seeing a sea of red that feels less like a market correction and more like a crime scene. The panic on the message boards is palpable. The doom and gloom crowd is out in full force, claiming this is the final nail in the coffin for the hydrogen giant. That is the expectation. That is the visceral, emotional reaction to seeing a double-digit drop in a single morning. But if you stop, take a breath, and actually read the filing that caused this crash, a completely different reality begins to form. What you are witnessing is not a death spiral. It is a calculated, albeit painful, amputation of toxic debt to save the patient. The market is pricing in bankruptcy fear, but the smart money, the institutional investors buying these notes, is pricing in a survival bridge to 2026. The headline screaming across every financial news terminal is simple: dilution. Plug Power Inc. priced a $375 million convertible senior notes offering. To the average retail investor using a Fidelity mobile app or checking their Robinhood stock trading account, convertible notes is just a fancy word for your shares are worth less. And on the surface, they are right. The stock is down 13.79% because the market hates uncertainty and hates equity dilution even more. However, the reality of this specific deal structure is nuanced. They are using this cash primarily to pay off high-interest debt and to repurchase the looming 2026 convertible notes that were acting as a massive wall of worry for the stock. By pushing this debt maturity out to 2033, Plug Power has effectively bought itself 7 years of runway. They traded immediate stock price pain for long-term solvency. That is a trade a serious management team makes when they believe the turnaround is real, not when they are packing their bags. Let's delve into the mechanics of this move because it is critical to understanding why the stock is trading at 1.84 USD and not 0. The new notes carry an interest rate of 6.75%. In a high-interest rate environment where distressed companies are paying double digits for capital, 6.75% is a signal of confidence from the lenders. It tells us that the institutions backing this deal, the sophisticated players on the other side of your sell order, do not believe Plug is going bankrupt next year. They are betting hundreds of millions of dollars that Plug will be around in 2033. The market's reaction today is a liquidity flush. It is the short-term traders and the weak hands exiting because they can't handle the volatility. But look at the volume. It is massive. Who is buying? Someone is absorbing these millions of shares at 1.84 USD. This brings us to the Project Quantum Leap narrative that nobody is talking about today because they are too busy panicking. Plug isn't just burning cash to build endless factories anymore. They are pivoting. The recent earnings report, while mixed, showed a crucial shift in strategy: asset monetization. They are looking to sell the electricity rights they secured for their hydrogen plants to data center operators. Think about that. We are in an AI boom where data centers are starving for power. Plug Power is sitting on gigawatts of power contracts. By flipping these contracts to data center developers, they can generate hundreds of millions in non-dilutive cash. This is the hidden asset on the balance sheet that the algorithm trading bots miss. They see hydrogen company and sell. They don't see power broker for AI infrastructure, which is what Plug is quietly becoming. The disconnect between the stock price and the book value of the company's assets is widening. We are trading at levels not seen in years, effectively wiping out the entire pandemic-era rally. For a value investor using Schwab Intelligent Portfolios or managing an individual brokerage account, this creates a dilemma. Do you catch the falling knife? To answer that, you have to look at the terms Tesla stock parallel. Tesla was days away from bankruptcy during the Model 3 ramp. They raised capital at the bottom. The press mocked them. The shorts piled in. But the capital gave them the bridge to scale. Plug is in its own production hell right now. They are scaling the Georgia plant, the Louisiana plant, and the Tennessee plant all at once. It is expensive. It is messy. But once these plants are fully operational, Plug shifts from buying expensive hydrogen from third parties to producing it cheaply in-house. That is the moment the gross margin flips from negative to positive. That is the singularity point. Today's 13.79% drop also needs to be contextualized within the broader energy sector. Oil prices are fluctuating, and the renewable trade has been decimated by higher-for-longer interest rates. Capital-intensive businesses like Plug are the first to be sold when the 10-year Treasury yield spikes. But notice how terms NVIDIA stock and other tech high flyers are relatively insulated? That's because they're cash-rich. Plug is cash-hungry. This makes them a proxy for interest rate sentiment. If you believe rates will come down in 2026, Plug at 1.84 USD is arguably a leveraged bet on the Federal Reserve. The moment rates tick down, the cost of capital for their massive infrastructure projects drops, and the valuation models re-rate significantly higher. Let's examine the institutional flows. While retail is puking shares, we have seen some interesting activity in the options market. The implied volatility is through the roof. This makes selling puts a potentially lucrative strategy for those with the stomach for it. By selling puts at the 1.50 strike, traders are essentially saying, I will buy Plug at 1.50 and you pay me a premium to wait. This is how the pros on the Interactive Brokers trading platform generate income from fear. They don't panic, they monetize the panic. The high short interest, currently hovering around significant levels, also adds fuel to the fire. If Plug announces a major data center deal or a new Department of Energy loan finalization, we could see a face-ripping short squeeze that sends this stock back to $3 in a single session. The core business, making hydrogen fuel cells for forklifts, is actually stable. Amazon and Walmart aren't stopping their use of Plug's GenDrive units. In fact, they are expanding. The issue has never been demand. It has always been the cost of the hydrogen molecule. Plug has been selling hydrogen at a loss to keep customers happy. This is the loss leader strategy from hell. But with the internal production coming online, that cost basis is set to drop by 50% or more. The market is ignoring this margin expansion story because it is focused on the cash burn today. But investing is about discounting the future. If you wait until the margins are positive to buy, the stock will be at $10 and not $1.84. I want to hear from the trenches on this one. Comment below. How long have you been holding Plug Power? Did you buy during the 2021 hype? Or are you a new entrant trying to bottom tick this crash? And honestly, do you believe hydrogen is the fuel of the future? Or is it a pipe dream that will never compete with batteries? We also have to talk about the political landscape. The hydrogen production tax credit, 45V, is still a major variable. The industry is waiting for final guidance from the Treasury. If the rules are favorable, Plug Power instantly becomes more profitable. If they are restrictive, it adds another hurdle. The market hates this regulatory limbo. It is pricing in the worst-case scenario. But consider the geopolitical angle. The U.S. government can't afford to let China dominate the hydrogen electrolyzer market the way they dominated solar and batteries. There is a strategic imperative to keep Plug Power alive. The Department of Energy's loan guarantee commitment of $1.66 billion is evidence of this. They haven't dispersed the cash yet, but the commitment is there. The dilution today is the bridge to get to that government cash. For those of you using investing sites to track insider activity, keep an eye on the filings in the next 48 hours. If we see the CEO or directors buying shares at these levels, it would be a massive vote of confidence. Conversely, if we see silence, it might indicate they are still cautious. But historically, Andy Marsh has been a buyer at these lows. The management team knows the intricacies of the technology better than any Wall Street analyst sitting in a Manhattan high-rise. When they refinance debt instead of selling the company, it tells you they see a path through the wilderness. The chart at 1.84 USD is entering uncharted territory. We are breaking below multi-year support levels. Technically, this is a falling knife. There is no clear support until historical lows from a decade ago. This is why the drop is so violent. There are no buyers left from the recent consolidation range.